Why is NextEra Energy crumbling in the market? It is down just this month alone, 20%. Year to date, the stock is down 37%. Why is NextEra Energy being hammered so hard? We're going to take a look in today's episode. We're going to understand exactly why this is. Why is this stock crumbling? On top of that, what we're going to do is we're going to jump into their financial statements, look at their revenue growth year on year, understand the big picture as well as their bottom line net income. We're going to jump into their balance sheet, take a health check, look at their total cash versus their total debt. This in turn is going to lead us into that all important dividend safety, as well as seeing some very important supporting financial metrics you need to understand before investing in NEE. And as always, we are going to jump into our stock valuation model, getting to our intrinsic value and finding our acceptable buy price given our margin of safety. Now it is crumbling down 37% year to date at a 52-week low, offering a forward yield of 3.5%. Now, is this been oversold by the market? Can we lock in this seemingly cheap price for this energy company and expect to see this double, triple, quadruple over the next 3 to 5 years and see this yield currently at 3.5 getting to a yield on cost to double digits? We're going to take a look at the historical performance too, but let's first see exactly what is happening with this company. Now, for those that don't know, NextEra Energy is the parent company to NEP, NextEra Energy Partners, and the majority of this essential crumbling, as you can call it, is due to the fact, as we can see here, it's slid due to the fact that NEP, so the subsidiary company of NextEra Energy, has revised its annual growth expectations all the way through to 2026, so quite a number of years into the future, for higher borrowing costs, which makes it more challenging, as we can see, to fund projects. Now, as you can see, it's not only NextEra Energy which has been down, but NEP, so shareholders of NEP can also see they have been suffering dramatically with this. And if we take a slightly deeper look at this, what we can see, so yes, this is the subsidiary of NE, but it also affects NextEra Energy. So NEP has received 2 downgrades after the company essentially revised its growth estimates, as we discussed, and JP Morgan have cut it down from $69 all the way down to $40. So this has meant a lot of suffering for NEP shareholders, but likewise, as mentioned, this does affect NEE, so you need to understand this. And again, the main reason of this is the higher cost of capital, as we can see with the increase in interest rates. And in terms of the growth projections, well, NEP had 12 to 15% in the future, forward looking, and now they revised it down to 5 to 8%. And as I mentioned, this is essentially till 2026, and they're not expecting much growth equity until 2027. So this will have a long-lasting effect on NEP as well as NextEra Energy. So do bear that in mind in terms of the future, and we will incorporate that into our valuation model to get to our intrinsic value. In terms of the last 10 years, well, how has that been for investors in NextEra Energy? Well, they have been up 159%, so it is still positive to see. And really, we want to see, can we take advantage of this cheap price right there at the 52-week low and lock in a cheap price and get this yield on cost into double digits? So let's take a deeper look into the company's financial statements, and let's start off with their top line, their revenue. December 2018, 16.7 billion on that top line. Now, what do we like to look for? Well, around 3 to 7% growth year on year. And 5 years later, December 2022, around 21 billion. So very positive to see what we can see, around 30 to 40% growth over the last 5 years. But on a more granular level, what's interesting to note, December 2018, they grew their revenues to 2019, but then they did drop all the way down to 21 before increasing it up again to 2022. So slight inconsistencies in their revenue growth. And when we compare that to their bottom line net income, what do we see? 6.6 billion net income December 2018 on the bottom line. December 2022, so it is their latest annual reports. Unfortunately, their bottom line has dropped, so it's not essentially in line with revenue, inconsistent. And again, we can see from 2018, their bottom line to 2020 has dropped, but then it has picked up again. So slight inconsistencies on the income statement side. We will take a look at the last 10 years percentage-wise shortly too. Balance sheet, so total cash versus total debt, a quick snapshot of the health of the company. So December 2018, they held around 638 million of cash. Latest quarterly report around 1.6 billion. So they are holding 1 billion more of cash over the last 5 years. But let's see numerically and directionally, how does that compare to their total debt? Well, we can take a look, in fact, at their long-term debt. 27 billion in December 2018, more than double in their latest quarterly report at 61 billion. So they are holding a significant amount more long-term debt, and this is a lot more of a jump than the cash, which was only an increase by around 1 billion. So I guess, how does that essentially affect the dividend safety and those important financial supporting metrics? Well, straight away, they have a dividend safety score of 90, making it very safe. Market cap, 107 billion, a mega cap company. And for those that believe a recession is looming, well, how did they perform in the last recession? So last recession, they in fact increased the dividend, 0709. Recession sales, negative 9%, which is not great that you want to see from any company you invest in. But do note, this was the average growth rate of companies in the S&P 500 during 0709. And as you can see, the recession return, they did have negative 31%, which again isn't great. But if you compare it to the S&P 500, 0709, this was negative 55%. So it did beat the S&P 500 in relation to total return. So a bit to digest there for investors who see a recession looming. Now, dividend growth. What do we love on this channel as dividend growth investors? We love to see double-digit growth. Latest increase this year, 10%, very strong to see. Last 5 years, compounded annually, year on year, 12%, very, very positive to see. And the last 20 years, still very positive in my opinion, 9%. Now, what do I always say to investors? I always say you want to aim for a minimum of 4%, whether it's your dividends, whether it's other income producing assets, or whether it's your salary. The reason for this, the US inflation rate over the last 40 years was 4%. So if you are getting anything less, you are in fact taking a pay cut and losing your purchasing power. Another thing to note, they have been paying increasing dividends over the last 27 years. So they are in fact a dividend aristocrat, which is a company that pays consecutive dividend increases over the last 25 years. Now, in terms of dividend yield theory states that the company is undervalued when the current yield sits above the 5-year average. As we can see, 3.54 versus 2.15, and it's also the highest the yield has been over the last 5 years. So this is our first sign of undervaluation. However, as I always say, do bear in mind we never look at any model in isolation, and we'll draw our conclusions towards the end of the episode. Now, in terms of the forward PE, again, another sign of undervaluation, 16.3 below the 5-year average of 28.1. And as we can see, the PE is slightly higher than the utilities sector PE. And as I mentioned at the beginning of the episode, it is towards the 52-week low, but do bear in mind 52-week low does not signal undervaluation. Likewise, 52-week high does not signal overvaluation. Now, earnings versus free cash flow. Again, regular viewers of the channel know we ignore the earnings metric and focus on the free cash flow, as earnings is susceptible to manipulation by management through accounting. But again, what we have to do in this case is ignore the free cash flow payout, purely because utility earnings payout is a more meaningful metric. The reason for this, well, their cash flow, as we can see, tends to be negative. The reason for this, again, capital intensive investments and long payback periods. So what do we look for in terms of utilities? Well, 75% and below. And what can we see for NEE? Consistently below 75%, very positive to see. And in fact, the last year was 59%, with 2023 expected to be 57%. So this right away gives me faith in that safety of the dividend. So far, so good. Again, personally, I prefer to look at the free cash flow metric for companies when analysing them, but it's not applicable for utilities. So earnings per share for NEE, 124 in 2013, more than double in fact in 2022 at 290. And what's more positive to see is the consistent increases year on year, as well as that 2023 figure expected to be 326. So very positive to see so far, increasing and consistently increasing. Now, sales growth, I mentioned we'll look quickly at the averages over the last 10 years percentage wise. So what do we see? Whilst we like 3 to 7%, we can see essentially the cyclicality of the nature, a few years of positive increases, a year or two of negative, as we can see here. So bear in mind, a company, utilities such as NextEra Energy, you will have that slight cyclicality, and we can see it here in terms of the numeric figures of the top line. 2013, 15 billion on the top line, and then we see in 2022, 21 billion. So we do have an increase over the last 10 years, but again, it is fairly inconsistent. So do understand that when you are looking to invest in this company. Now, shares outstanding, we love it as shareholders when companies do share buybacks, returning excess cash to our pockets. But with utilities, what typically tends to happen is because they rely on equity to fund essential projects, they do tend to issue essential equity. And therefore, what does that mean? Well, it means it dilutes your position as a shareholder. So 2013, they had 1.71 billion worth of shares outstanding, 2022, 1.98. And as we can see, it has been increasing. But one thing you could argue is that they aren't increasing those shares at a very rapid rate. So that is a slight positive in my opinion. ROIC, return on invested capital, one of my 7 golden dividend metrics. What do I personally love to see? Well, I like to see 10% plus. The reason for this is essentially because it means management are able to effectively allocate that capital. However, with utilities, we tend to see between 5 to 8%. And as we can see here, that seems to be the trend. Although one thing I would say is that over the last few years, it has been around 3%. And I would like this to go back up to at least 6 to 7%. So again, something just to keep an eye on moving forwards. Again, free cash flow margin, whilst this is a metric I do like to look at, again, not relevant for utilities. So operating margin, 18% plus is our preference. And every single year they've consistently hit that or increased it. The one slight thing to note is from 2020, it has dropped down quite significantly to 18%. So again, 2023 and onwards, when we see the metrics, we would like to see this go up to around the consistent levels we'd seen before, between 23 to 35%. Now, one slight worry of mine here was the net debt to earnings before interest, tax, depreciation, and amortization. The reason for this, as we flagged in the balance sheet review, their cash had increased by around 1 billion. However, their total debt, or long-term debt, in fact, had increased quite significantly, around 20 billion. So what we look for here is around 5.5 signaling the number of years it would take the company to pay off all their debt, net of cash on hand. For the large part, it has been below that, but we can see from 2020, it did creep above that. 2021 and 2022 significantly higher. Now, this is a worry, personally, in my opinion, especially to that dividend safety. The only positive I would say is 2023, it is expected to come down below 5.5 to 4.96. So again, this probably wouldn't be a negative in my opinion, but it is something just to bear in mind and to ensure when we get the 2023 annual report over the next few months that we can see that this has dropped to lower than what we saw in 2022. On the right here, we just see the percentage of a company's financing from debt as opposed to equity. As always, if you are enjoying the content, value is being provided, smash that like button, hit that subscribe button and the bell if you want to be continually notified of these stock videos. And as always, if you want to grab a copy of the model to run your own companies through in your own portfolio to get your own intrinsic value, do click on the pinned comment below and grab a copy. Now, so let's jump straight into the valuation model. Now we're going to jump into Graham's valuation. So with Graham's valuation, we put our stock ticker in NEE, the earnings per share at 405, growth rate per analyst estimates forward looking at 9, with that yield on AAA corporate bond at 5.46, giving an intrinsic value on Graham's valuation formula at $52. Now, when we take a look, essentially, Graham's valuation model is saying that the current market price is trading at a fair value. However, do bear in mind, as always, we never look at any of these models in isolation, and we'll draw a conclusion towards the end of the episode. So the second model that we're using valuation-wise, companies in a similar sector and size for the multiples valuation model. We have Ameren, Southern, Duke Energy, and NextEra Energy. We have their stock price EPS to get the P multiples. We get the average, multiply that by the EPS of NEE to get a stock price of $76. Now, when we take a look at that, that is some significant upside to the current trading price within that 52-week range, but showing undervaluation where this is a cheap price and that yield on cost will only go higher and higher. We then move on to the third valuation model, which we have the dividend discount model, the yearly dividends, as we can see. Nice growth rate over the last 5 years, on average looking at around 11%. And as we can see, forward looking, I've estimated around 5.5%. Now, that is something where you could argue why so low given the average growth rate 11%, but we did see the growth rates forward looking is starting to come down, and I do expect that to affect the dividends, and therefore I've gone for around 5.5%, still above the inflation rate at 4%. As always, if you want to justify a higher or lower percent, do grab a copy of the model in the pinned description below and put in your own figures based on your own investment thesis. This gives a DDM price of $79. As we can see, some strong upside to the current price, but within that 52-week range, again showing signs of some strong undervaluation and oversold by the market. We then move on to the fourth and final model, the DCF discounted cash flow model, where we have our free cash flows year on year. We then have the average growth rate at 31%. Forward-looking analysts estimating 24%, so lower than that average growth rate, and we could expect that to go even lower given the growth rates that have been estimated by their subsidiary NEP. With our discount rate, we get the present value of future free cash flows and terminal value. Add that with the cash, subtract total debt, and we get our equity value. Divide that by the shares outstanding gives a DCF price of $66. Again, showing some nice upside to the current trading price, around 30%. And again, within that 52-week range, showing that if you do lock in these prices, you will see that yield on cost go up further and further towards the double-digit mark. So the intrinsic value is essentially the average of the four models we have just run through. And again, if you enjoy the content values being provided and you want to show your appreciation, all it is that free smashing of the like button. It really helps the channel grow and increase our community. As always, if you do want to grab a copy of the valuation model, do check the pinned comment below and grab a copy. So our intrinsic value is coming to $68. Now, looking at the current price around $53, typically I'd say a margin of safety of 10% if you're looking for a wide moat, good forward-looking data, and some nice financial metrics. For NextEra Energy, especially given the macroeconomic conditions, as well as that of its subsidiary NextEra partner. Personally, I think 10% is a way too low of a margin of safety. So if you're looking at 15%, your acceptable buy would be up to 58. If you're looking for a margin of safety of 20%, your acceptable buy would be up to $54. So if you were to lock in price of today based on the estimates and judgments, you'd be getting at least a 20% margin of safety. For those looking at 25%, you'd be looking at around $51. And as we can see, that is towards that 52-week low that we've seen very recently. Now, Wall Street, well, they're forecasting over the next 12 months for this to go even higher than our intrinsic value to just shy of $80. As always, let me know your thoughts in the comments below. Are you looking to add NEE? Are you looking to sell? Or purely on the sideline speculating? Or let me know even if you're invested in their subsidiary, NextEra Partners. As always, smash that like button if you've enjoyed today's episode. Hit the subscribe and bell if you haven't already. And as always, if you want to grab a copy of the valuation model, check the pinned comment below. Have a great day and catch you on the next episode. Goodbye.